Hello everyone and welcome back for another edition of the Money Pros. I'm Oliver Tutz, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me tell you about what we've got in store for today's show. First up, we're going to be talking about the fiduciary rule. Now, this is not something probably you're super familiar with, but we've talked about it several times on the show over the past couple of years, and there's an important update that I want to share with the Money Pros audience. So we'll go through that. Then we are joined by our mortgage pro, Steve Tetzner from Homestar Mortgage. The mortgage and real estate market is red hot, and we're going to be talking about how that hot market is impacting the borrowing decision that buyers are having to go through, and also how it may be affecting sellers as well. So we have that to look forward to. In our third segment, we're going to be talking about financial procrastination. There was a recent survey done that talked about the prevalence of procrastination when it comes to financial decisions, and I'm going to have some suggestions on how maybe you can get a little momentum going and overcome some of that procrastination. And then finally, we have a question from a viewer on backdoor Roth IRAs. It seems to be a common topic, so we're going to talk about that real quickly in the final segment. So having said all that, let's jump right into it. And what I want to start off by doing is updating the audience on something called the fiduciary rule. Now, we started talking about this way back in 2016. So this rule was proposed by the Department of Labor under the Obama administration. Now, the Department of Labor is exactly what it sounds like. It's the department responsible for the regulation of the workforce and labor rules and things along those lines. But when it crosses over into investments is because they have authority over retirement plans. And most of us think about retirement plans as pensions and 401ks and things along those lines. But individual retirement accounts are also retirement plans, and they fall under the purview of the Department of Labor. And while the Department of Labor usually focuses on things related to fair employment and things along those lines, they waded into the investment world by creating a rule called the fiduciary rule that suggested that required, I should say, that any financial advisor that dealt with retirement plans, including IRAs, was required to act as a fiduciary for the client. Now, this is significant because the vast majority of financial advisors, all of those that work under commission, do not work under a fiduciary standard. They work under a lesser standard as to whether the investments are considered suitable. It's called the suitability standard. It does not rise to a fiduciary level, which is the idea that the solutions or recommendations or advice that you're providing for your client are the absolute best possible. So the fiduciary rule significantly raised the standards bar and standards requirement for financial advisors. It created quite a bit of turmoil in the industry. Now, because this rule was so significant, it was proposed back in 2016. There was a lot of public comment, but the rule was not scheduled to go into effect until April of 2017. Of course, now President Trump was elected to office in November of 2016, and then shortly after he was elected, his administration announced that they would be suspending the rule temporarily to do more research. So it never went into effect in April of 2017, although all financial services organizations were making a lot of effort to be able to comply with it effective April. The Trump administration put it on hold for further research. Meanwhile, the rule was challenged in court in the Fifth Circuit Court of Appeals in Texas, Louisiana. It covers 3 states. The rule was challenged, and that court case finally came to completion, and the Fifth Circuit Court of Appeals determined that the Department of Labor had overstepped their authority in creating this rule and overturned the rule. So at this point in time, the fiduciary rule is dead, and financial advisors are not required to meet that fiduciary standard if they're dealing with retirement accounts. But what I think is interesting about this whole story is the reality that even though the standard is no longer required for all financial advisors, the conversation around fiduciary responsibility is more than I've ever seen in my years in the industry. I can think of a recent example of a prospective client that came to my office, and among the myriad of questions that they ask when they're interviewing a financial advisor, one of the questions was, are you a fiduciary or not? 10 years ago, I never would have gotten that question. So despite the fact that the rule has not been implemented and its future is certainly in doubt and at this point is dead, I think it's done some interesting things with respect to bringing to the public's attention what responsibility and what level of advice financial advisors are actually bringing to their clients. So in that respect, perhaps some progress was made. All right, up next, we're going to be talking to a mortgage pro, Steve Tetzner, about the red-hot real estate and mortgage market and what it means for borrowers. Stay with us. There's more to come. Welcome back to the Money Pros, joined now by our mortgage pro, Steve Tetzner with the Homestar Mortgage. Steve, welcome back to the show.
Thank you.
I don't know, it's probably like 85 degrees outside, so it's hot. But that's not the only thing hot in Rhode Island. And we always like to preface, particularly your segments, because when we talk about interest rates, everything is so time sensitive, to say that we're recording this in the beginning of July. So depending on when folks are listening to this, take that into consideration as we're thinking about it. But things are... they're hot. So let's start off with a market update. What's going on in the mortgage and real estate markets? What's your perception of things here in Rhode Island?
The real estate market is crazy right now. It's definitely a seller's market. Right now, there's about 2 months of inventory. What that means is that if another house didn't come on the market, in 2 months, the inventory that is available would be gone. A stable market is about 6 months of inventory. That's where it's a balanced market. So you can see that the pendulum has really swung towards being a seller's market. It has been for the last probably almost 2 years, but it's getting worse. Houses are coming on the market. They're selling very quickly, very aggressive bidding wars. Interest rates have kind of stabilized. We saw a spike in rates when I did the last show. 30-year rates are in the mid-4s right now. We are predicting that we could see rates as close to 5% by the end of the year, but right now we're still seeing a pretty stable market in the mid-4s. Do
you find it challenging when clients ask you to predict where interest rates are going to go? I mean, it's like somebody asking me to predict where the stock market's going to go, or I think the weather is a little more predictable, but is that, clients, they're looking for guidance, right? Sometimes it's tough to provide them, none of us have a crystal ball, right? How do you handle that?
You know what, I really try to look at what's happening in the market trends, and I subscribe to a bunch of different services that I can provide them data and say, nobody really knows for sure, but here's what a lot of the industry experts are thinking. This is what we think the trend is going to be. Most people you're talking to are going to buy in the short term, so it's easier to give them guidance. Most people will usually lock a rate in once they've signed a contract on a house. They don't gamble once they've got a contract on a house. But people that take 6 months or a year to find a home, they've experienced almost a full percentage point spike in rates from where they were a year ago. Becomes a big variable.
So prices are moving up. The limited number of properties that are available are moving very quickly, and we are seeing interest rates rise, although you noted that they have stabilized to some extent. How is that impacting buyers' feelings of urgency? I mean, people plan the purchase of a residence, based on lifestyle. It's not purely an investment for them, but it must be impacting people's motivations when they're looking at properties, or whether they're making that determination to buy or not.
Absolutely. The fear of higher rates is making people want to move faster, and also with the rising prices, they're trying to get in now because they're afraid that a house that they buy today for $300 is going to be $325 next year. So they are getting very aggressive, and we have a lot of people that are in the market that have been looking now for 6 months, 9 months, a year, even longer, and they've made multiple bids on properties and keep losing the bid because some houses have 20, 30 bids on the properties, and
it's got to be
people are getting frustrated.
Okay.
They're getting frustrated. The type of financing that they're doing, how they're structuring their offers, all that stuff is really coming into play now.
Are you getting the sense that with the frustration, hopefully they're not starting to make bad financial decisions, that they're overpaying, overextending themselves? I mean, do you sense things getting to that kind of frenzy at this point?
Well, I mean, we're certainly seeing values go up, but it's hard to say if people are overpaying because the prices are still rising.
Right.
And
if you're sitting on the sidelines without a house, it's tough to say that.
Right.
You didn't overpay, but you're also homeless. Right.
So that's a tough call, but we're in a market where it's not like it was 10 years ago, where people were getting mortgages who didn't qualify. So people qualify for these loans. They're very reasonable, and most people are not maxing out on what they can really afford to pay and what they pay on a monthly basis. So, I think the market's just very, very strong.
One of the things we've talked about on the show before, but it seems like from what I've learned from you is always a concern in a rising market is the appraisals keeping pace with the rising prices. So you have this situation where you in typical form, you bid on a house, the offer is accepted, then you've got to go through the loan process, and the house has got to appraise for enough to justify the loan that the buyer is looking to take out. And the appraisals are based on comps that happened, maybe weeks or months ago,
Correct.
right? And if the market is doing one of these things, that may not be recent enough data. How is the appraisal thing working out for your clients? Is it becoming a challenge for people?
In some cases, but what we usually see is the appraisal's an issue when they're grossly overbidding from the listing price. So the house is on the market for $299,900 and they're bidding $335,000 for the house. So and then it appraises at $320,000. But for the most part, the realtors that are experienced are savvy and they understand, and they'll say, well, you know what? Let's hold the appraisal for a few days because I know this house on 2 streets over is going to close, and I know that is going to sell and it's going to be a great comp for us. So let's wait till that closes before we do the appraisal on this one. So I think that with the experienced realtors involved in the transaction, we're having a lot less problems with the appraisals and the properties.
Interesting. Do you find, as an aside, it just occurred to me, in a hot market like this, you talk about it, and we've talked about it on the show before, the importance of experienced advisors, whether it's a mortgage originator or it's a real estate agent or whomever it is. Are there a lot of new real estate agents in the business? And is that a challenge for you sometimes?
It is. We have a lot of...
You got to work with everybody, and you got to learn somehow, but...
Right. Yeah, and we have to watch the information they're putting in the contracts, make sure there's no personal property, make sure the contracts are being written up correctly. But for the most part, the realtors have good training. They have to go through classes. But obviously, an experienced realtor is definitely going to be a better realtor to work with because it's not just understanding the process, but it's understanding the market and understanding the trends. Understanding the individual neighborhoods. Should the house be selling for that much money? So there is no substitute for experience.
And getting back to the appraisal question, you feel like the appraisal is an important safety check on the whole lending system, that they're still being done in a way that is facilitating business but keeping the lender safe, maybe unlike decades past where we've run into problems.
Yeah, and with the appraisal process that's been in place for years now, where it's an independent appraisal process, the originators don't have, the salespeople don't have an influence over the appraiser. It's a random the appraisers are chosen randomly from a certain list. So there's a lot of protection that there is not any undue influence on the appraiser to inflate a value greater than what the real current market value would be for the house.
So whenever I hear about and we've been talking about the hot real estate market for a while, so it's always a concern for someone like me as a financial advisor is the issue of affordability. The more people have to pay for their housing, the less they have for other things like retirement savings and all the other things we talk about. What are you seeing in terms of as prices rise and interest rates have gone up somewhat, the issue of affordability? Are you still seeing people being able to qualify for the loans? Or do you see people being pushed out of the market that at one point in time would have had an opportunity to buy but no longer do? How is that all unfolding right now?
The low end of the market, the first-time home buyer under $200,000, that's having a huge effect on them. When you see a full percentage point increase in the interest rate, you see market values, probably up 15% from 2 years ago. Someone could come in and say, well, I want to pay $1,100 a month, or that's what I can afford. We could get them into a house for maybe $130,000 with no money down. Today, first of all, there are no houses for 130,000.
So problem number one, no inventory.
No inventory for those people. You know, those $130,000 houses are now 150.
Right.
Now interest rates are up, so you know, even if the houses were available, that payment's not $1,100 anymore; it's $1,200. So those factors are really affecting the first-time home buyer and the low to moderate income buyer much more than the repeat buyer, because the repeat buyer is selling a house, which means that they're taking advantage of the higher market.
Sure.
They have the ability to roll more equity because they're selling the house for more money. So it's really the first-time buyer market.
Can you offer any advice to them on, do you sit tight? Do you build up your down payment? Is there anything they can do to make it better for them? Are there programs available, perhaps, that a lot of people aren't aware of?
Unfortunately not. It's really a situation where if that's what they qualified for, most of them are in a situation where their income isn't going to rise very much.
Right.
They need low down payment programs because what they're paying for rent would be equal to what they're paying for a mortgage. There's really not an opportunity for them to save that's going to influence what they're going to be able to spend on the other side. I think that to get those people back in the market, we may have to see some more creativity on the mortgage side with the first-time home buyer, maybe bring back the 40-year mortgage, in a fixed-rate product to help to get the payments down a little bit.
And just really quickly, with about half a minute left, how is it impacting sellers' decisions? I mean, they know they're in the driver's seat right now. How is it affecting their mentalities, this hot market?
It's, if they don't have to, they're not taking buyers with contingency. So if you have a house to sell, forget it. If you're not doing financing that they like, so if they have 3 offers on the property, one person's putting 20%, one person's no money down, and the other guy's doing an FHA, they're going to take the 20% down buyer. So that's affecting the first-time home buyer and some buyers because they're losing houses not because they're not good bidders or have good credit, but the sellers say, well, I've got better financing with other offers at the same price that are less risky.
It's an incredible market, and we were talking about before the opening. I'm always waiting for the other shoe to drop. You're a lot more optimistic about it than I am. So, but it's great to get this information, and we welcome it as always. So thanks for being with us.
Glad to be here.
All right, up next we're going to be talking about financial procrastination. Stay with us. There's more to come. Welcome back to the Money Pros. So, are you a procrastinator? I have to say, I am definitely a procrastinator. Folks at the station would tell you that when I'm trying to get them material for a show. I'm always last minute. My wife would tell you that. If I can do something tomorrow that should be done today, I will definitely do it tomorrow. One of the things about procrastination, though, is that it becomes particularly prevalent with financial procrastination. I have to say I'm pretty good about that, as you would expect. I tend to procrastinate with other things. But for a lot of people, putting off financial decisions is definitely the way they operate. So there was an interesting survey recently from Principal Financial. Did a survey, and their survey indicated that 7 in 10 Americans admit to postponing financial decisions. So 70% of us put stuff off, and 56% said that they've made no major decisions in the past 3 years. I'm not sure if that's that alarming, but I do think that it points to the fact that people don't like to make major financial decisions, so they try to avoid them as much as possible. And interestingly, only 30% of the people that were surveyed felt comfortable with their level of financial knowledge, and that ties in quite a bit to why people procrastinate financially. So I thought about financial procrastination and wanted to try to provide some ideas on how you might overcome it. There are no secret weapons here, but try to conceptualize some of these things. And if they work for you to get you to move forward on some of your financial decisions, then that's great. So let's throw up a slide and we'll talk about each one of these. And the first one, I really believe this, is you've got to envision your financial future. I think about the future a lot. I'm a planner. It's in the title of what I do, right? But I'm always amazed at the number of people that really only live in the present, which can be very healthy in a lot of ways, don't get me wrong. But from time to time, you have to project out into the future and think about how your current actions are going to impact your future, how the ramifications of your future. And so if you can envision your future, where you want to be, what it's going to cost you, and I'm not even talking about taking out a pencil and a paper, but if you can just think about it, if you can view it as a reality instead of something that's never really going to happen or that's so far away that you don't have to worry about it, then making decisions now to benefit that future that you envision become a lot easier. So I start with, you got to have a vision for the future, and it's not that it can't change, but you have to spend some time thinking about it. Next up, get educated. So this really gets back to the idea that only 30% of people feel comfortable with their financial knowledge according to this principal survey, and there are other surveys that would bear that out. It's much easier to make decisions when you feel like you have a little bit of information. So use things like this show, plenty of online blogs, articles, and other resources, but you have to take some time to get a little information. You don't have to be a rocket scientist with your finances, but you should be comfortable with some common concepts, and once you are, it becomes a lot easier to make decisions. Number 3, don't make excuses. Look, I've heard too many times, oh, I'm going to do this once this happens, or, you know, Oliver, I'm going to call and make an appointment with you to talk about my finances as soon as I get my other stuff, you know, my other finances in order. Well, that's what we do. So don't make excuses about why you can't start. There's no time like the present. And finally, don't fear failure. A lot of people are afraid to make decisions because they're afraid they're going to be the wrong ones. I saw a quote recently that said, be right, be wrong, just be certain. The idea here is make a decision. Don't fear whether it's the right or wrong one. Just move forward. With some education, I'm confident you'll make more right decisions than wrong ones. All right, up next, a viewer question on backdoor Roth IRAs. So stay with us. We'll be right back. Welcome back to the Money Pros. Viewer question we have today is kind of an amalgamation of a bunch of questions I've gotten recently. They seem to come in bunches, different topics, and this one has been hot lately, although it's not a new concept, the backdoor IRA. The idea is, I've been reading a lot about the backdoor Roth IRA. Is this something I should be doing? Well, you know, whether or not you should be doing it or not really depends on a lot of things with respect to your finances. But the idea here is that not everybody can contribute to a Roth IRA because there are income limitations. However, everybody can contribute to a traditional IRA without taking a deduction, regardless of your income. And anybody can convert their traditional IRA to a Roth IRA regardless of their income. So the backdoor Roth IRA concept is that you would contribute to a non-deductible traditional IRA and then convert it to a Roth IRA. As to whether it's an appropriate strategy for you, I think it's better for people that are younger. As you get older, and I'm not going to put numbers with those terms, it becomes less and less attractive of a strategy. Roth IRAs are certainly very attractive from a tax standpoint, but you have to commit to that strategy over a series of years because the best you're going to be able to do is $6,500 and convert each year. So it would take you 10 years to put away $65,000. So keep that in mind. It's a hot concept. It may work for you, but there are also a lot of pitfalls, so beware. Thanks for watching Money Pros this Sunday. We'll see you again next week right here on the Money Pros. Take care, folks.